How do economists know how well the economy is doing? Well, economists collect statistics on production, income, investment, and savings. This is called national income accounting. The most important measure used by economists is GDP. It is one measure that tells us how well the economy is doing. Gross domestic product, or GDP, is the dollar value of all final goods and services produced within a country's borders during some time period, usually 1 year. Not everything is counted in GDP. We don't want to count goods twice, so we only count final goods and services. For example, we don't count intermediate goods, those goods like tires that are put on a car that's going to be sold or the radio that's put in that car. So we only count the finished goods, the car itself. We also don't count used goods because they've already been sold once. Purely financial transactions are omitted because there's nothing produced. An example of a purely financial transaction might be the purchase of stocks, bonds, or transfer payments such as the student aid you'll receive once you go to college. Household production is also omitted from GDP. This is because there's no payment received for the work that you do when you repair your car or mow your lawn. And finally, non-market or illegal activities are omitted from GDP for obvious reasons. There's no record of the transaction of the sale of illegal goods or of unpaid work. For example, when you agree to do work for someone and they pay you in cash and neither of you reports it to the Internal Revenue Service. There are two ways of calculating GDP, and you really need to know both. The income approach is where we add up all the income that resulted from selling all final goods and services produced in the given year. You really only need to know what the income approach is, as you probably won't have to calculate it on the AP exam. The expenditures approach is the second way of calculating GDP. This is where economists add up all the spending on final goods and services produced in a given year. Both ways generate the same amount since every dollar spent is a dollar of income. You will have to know the formula for expenditures approach and be able to use it. The expenditures approach includes all consumer spending, the money that consumers spend on final goods and services, plus all government spending, the money that the government spends on goods and services, plus all investment spending, the money that businesses spend on goods and services, and beware of this category as it includes new homes that people purchase, as well as business inventories that's remaining on the shelves at the end of a production year. Then we add in the exports that are produced in a nation and subtract the imports that are purchased from outside the nation, and that will give us the total GDP, or final goods and services produced in the economy. You also need to know how economists use GDP. We can use it to show how much GDP changed from year to year. To do that, we would use the percent increase formula. We would take year 2's GDP, subtract year 1's GDP, divide it by year 1's GDP, and multiply by 100. For example, if GDP was 120 million in year 2 and 100 million in year 1, 120 minus 100 gives us 20 million, divided by 100 million gives us 0.2 times 100 means that GDP grew by 20%. Between year 1 and year 2. Inflation can make GDP appear better from year to year when it is not, because we have to take into account real versus nominal values. Nominal values are the named values, that 120 million we were talking about. Real would be adjusted for inflation. So real equals nominal minus inflation. Real GDP per capita is real GDP divided by the total population. It identifies on average how many products each person makes. Real GDP per capita is the best measure of a nation's standard of living. Now you know how a country can measure its well-being through gross domestic product. I look forward to speaking with you next time on a new topic.